Well, turning back to the markets, which are now higher after some early losses, the Dow and S&P both trying for a second straight day of gains. So how should investors position ahead of tomorrow's Fed decision that we were just talking about? Nimrit Kang is Chief Investment Officer and Senior Portfolio Manager at NorthStar Asset Management. She's also a new face to CNBC. Welcome, Nimrit. It's great to have you here. So you just heard our discussion with Gus. I guess I'll have you sort of pick up on what you think the Fed will do and then how you would be positioning investors from there.
Yeah. Thanks for having me, Kelly. No, so we are with the market that Fed is in wait and see place here, having put through 500 basis points of interest increases over the last 18, 19 months or so. In terms of how we're positioned, the only thing we feel very confident and certain about is that we expect higher degree of uncertainty and volatility in the market. So with that, we're very focused on risk. And in that framework, if you think about it, we're looking at bonds that we can get at 5 to 6% yield, secured by contractual obligations by the U.S. government. That sounds pretty good to us right here, Kelly. So we are, where it makes sense, where our clients are underweight their fixed income, we are building out fixed income ladders for them and getting them that 5 to 6% income while maintaining flexibility for them as well.
It is really interesting, obviously, with what's going on right now, because we haven't seen interest rates this high in many, many years, more than 15 years or so, I believe. And so now you are looking to fixed income products, particularly for a subset of investors, perhaps, that are more cautious or less risk averse when you're looking at equities versus bonds. I mean, I find it very interesting here when you're talking about the wealth transfer. Why is that something important to consider when you're looking at bond investing versus equity investing in this environment that we haven't seen in quite some time?
Yeah, no, absolutely. One of the key things we see here with the interest rates going up to the 5% range and this new monetary cycle that we are in, for years, retirees and other savers have not been able to get any interest on their securities. All of a sudden, there's interest coming. I just recently read the U.S. government is paying somewhere close to $600 billion in interest. That's going to go all the way up to $1 trillion. That's going to someone, and that's going to the savers. And when we think about the demographics for our country with the number of retirees coming on board, 1 in 6 Americans is over the age of 65. This cohort is going to grow by 35% by 2030. Those people do need that income. So from that perspective, we think it is actually a very good tailwind. The other thing I would say, Kelly, we still very much believe that sticking to long-term strategic asset allocation is the way to go. Again, depends on the time horizon for various investors. But time and time again, what we've learned, from the market is staying invested is the best way to have those long-term returns. But when we think about staying invested in the market, we want to own those high-quality stocks for companies with balance sheets that are strong, that have good cash flows, that are not dependent on the financial markets for their financing needs. So within that, we see plenty of ideas as well.